the price of Bitcoin is climbing, hitting a new all-time high on Monday. CGTN's John Terrett tells us why from New York.
There is no doubt that Bitcoin is on a tear. The question is, why is it? Now, people who really believe in cryptocurrency, and I don't think anybody seriously thinks that cryptocurrency is completely going to go away, but people who believe in it and have been rather upset by seeing Bitcoin fall so low recently are texting each other and appearing on social media and saying things like, "We're back." And there are three reasons for it, apparently. Number one is spot ETFs. Now, an ETF is an exchange-traded fund, and until 2 months ago, you could invest in an ETF in cryptocurrency and Bitcoin, but only on the future direction of it. 2 months ago, almost exactly to the day, the government in America introduced the chance to have ETFs where you buy what they call spot or actual prices. In other words, real cryptocurrency, real Bitcoin. You actually buy a slice of the coin itself, and then you ride its fortunes either up or down. Now, there's been a real inflow into these ETFs in the last couple of days and weeks, and that is because there's a deadline coming up. It happens every 4 years when the cryptocurrency miners pull back on the amount of mining of Bitcoin that they actually do in order to keep the number at an even 21 million. They don't want it to go higher than that. So those are the key reasons why Bitcoin is doing well at the moment. There is another one, slightly less important. Donald Trump, former president, running again, almost certainly to be the candidate for the Republicans in November, telling CNBC, the business television station, sometimes I will let people pay with Bitcoin. And we think that may be elevating Bitcoin a little bit as well. Bitcoin, of course, when it came on in 2009, was valued at zero. At the height of COVID, it went much higher than that, but its low was in November 2022, 16,216. At the end of this Monday trading session, it's back up to 72,200, a gain of 3.6% on the day. But there are some red flags. JP Morgan, the big bank, the key analyst there who watches these things, thinks that asset inflation in technology and crypto, especially Bitcoin, may actually temper the Federal Reserve's chances of cutting interest rates. The Wall Street people think it'll happen in June, but JP Morgan is warning with this inflation in tech that we've seen and now cryptocurrency, especially Bitcoin, that actually the Fed may delay an interest rate cut. And the markets on the Monday session went into the close with a sense that maybe, just maybe, there is a sort of momentum meltdown about to happen as technology stocks fall again. So at the end of the Monday session, the Dow was ahead by 46 points, a gain of 1/12 of 1%. The Nasdaq was down, though, 0.4 of 1%. The S&P 500, well, it was at 5117, down just over 1/10 of 1%. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
And for more on Bitcoin's heady surge and other market insights, we're joined by Thomas Hayes. He is the founder, chairman, and managing member of Great Hill Capital. Always good to see you, Thomas. Thank you so much for your time. So Bitcoin is on a real tear, right? The latest push driven by news from the UK. It's considering the possibility of opening the door to exchange-traded notes on an institutional level, not retail, just to be clear. How big a deal is it, and do you think it opens the door to institutions in the US picking up more confidence in the space? Outflows from Bitcoin ETFs since inception in the US have been quite sizable.
Yeah, thanks for having me, Karina. You know, there has been a lot of activity in Bitcoin as it relates to the ETF flows and more advisors starting to think about whether clients should have a 0.5% or 1%. So that's driving demand. You have the halving happening, as John had mentioned, in a few months that will limit supply. You also have the UK story. But I think the real story here, Karina, because we don't focus on Bitcoin, we focus on solid companies, productive companies with free cash flow. The real story is the market is trying to sniff out the Fed cutting. And Powell had indicated that he just needed a little bit more evidence when he was in front of Congress to begin to lower borrowing costs. So I think that's driving all risk assets. You've seen it in energy. You've seen it in equities with the S&P up 27% since late October. Semiconductor index up 77% since late October. So I think a lot of this has to do with the cost of money and animal spirits coming back into the market.
Oh, we've seen some heady profits, but we're seeing a bit of a pullback now, some profit taking in the broader U.S. markets. That's after a record run in equities and bonds. That's a result of overbought conditions, some say. Is it time to hedge? Are we seeing the start of some kind of a bubble, or are we just in the middle of what could be a really, really sweet spot, particularly after Friday's pretty perfect jobs report?
Well, the answer is we don't know, Karina, but I can tell you this. We were extremely bullish since October 2022. It was very, very lonely over the last year and a half during many particular periods. And only lately in the last couple of months have you seen the people who had been bearish the entire 50% rally start to flip bullish. And that's usually a sign, not necessarily that we have to crash or anything extreme like that, but a pullback would be in order, maybe 4 to 8%. It's also normal seasonally in this period of the year during an election year between late February and mid-April to see a pullback. So despite being bullish and constructive for the year, because the average election year is up 11.28% since 1928, we did put, for the first time in a long time, 2 1% equity hedges on our portfolio, one on the S&P and one on the semiconductor index. If we're wrong, we're fully invested, we're constructive and long, the rest of the portfolio will go up. If we're right, that short-term pullback will create some excess capital for us to invest into year-end. So I think intermediate to long-term, very constructive. Short-term, a little bit cautious, because you got to look at earnings were good, up 3.4% when they were only expected to be up 1%, but we're trading at 20.7 times forward earnings right now. That's a little bit rich.
It is quite rich, but some analysts say there's still a lot of liquidity around, evidenced by these record markets, crypto investment as well. They believe if the Fed cuts rates, money will pour into stocks. So do you have that impression as well? If so, will it be broad-based investments or sector-specific? Any particular stock picks that you have?
Yeah, I do think that is correct, and I think it's coming a little later. You know, the big number, we saw obviously average hourly earnings come down. We saw the unemployment rate go up. That gives the Fed cover, but the big numbers are tomorrow, the core CPI and CPI, and then on Thursday, the PPI reports as well. And we're going to find out just how quick the Fed can go. We've been getting these statistical and seasonal aberrations, and the lagged effect of owner's equivalent rent has not been kicking in, so the numbers of late haven't been as good as we wanted. I think the opportunity, Karina, is going to be the heavy-weighted tech that's driven the rally is going to slow down a little bit, maybe perform less well in coming months, and then the opportunity is in those companies that have lagged. Start to look at small caps, start to look at utilities, start to look at REITs, start to look at the groups that have underperformed now starting to participate. Industrials are starting to break out, biotech starting to break out. So there's a lot of opportunity under the surface, even if the indices stutter a little bit and then pick up in the back half of the year.
And then, as you say, fresh inflation data about to come out. What are you expecting to see in that data? And then what do you see the Fed doing? When do they pull the trigger on a rate cut?
Well, if we beat expectations, you know, they're looking for 0.4 month on month for a headline, 3.1% year on year. If we see a 2 handle, 2.9, 2.8, that could be bullish now for the markets. I think given the recent pattern with a little bit of seasonal oddity to the numbers that won't be sustainable over coming months, but for the temporary point of view, the fake out has been the numbers have been coming in a little bit worse than estimates, and people have been getting worried. The answer is we just don't know. We're going to have to wait till tomorrow morning and find out. But if you do get a 2 handle on that headline, I think you're going to see some short-term buying for sure. If you come in at 3.2, people are going to get worried again, and that could, in fact, be a catalyst for a short-term pullback until they finally get to cuts. The key with the Fed is the sooner they start cutting, the less cuts they'll have to do. If you wait for the robins to sing, it's already spring. Sometimes waiting for too much evidence is going to be too costly. So we'll see how it plays out, and we're going to see those dot plots for what they expect to happen and some discussion about the taper this month.